Hi, everyone. Welcome to How to Hack Angel Investing. We're going to get started shortly. We're just waiting for a few more people to join. All right. Hello, I'm Bianca Gabon. I lead partnerships at Republic, and we're really excited that you joined us today. This is our third investor education webinar, and we're really excited to be partnering with our sister company, AngelList, on how to hack angel investing. I'm going to go through the agenda, and then we'll kick it off. So today we'll have about 30 to 45 minutes of content, and then we'll leave time for Q&A. So be sure if you have questions to feel free to ask throughout. There's a Q&A button at the bottom of your screen. You can click on that and ask questions. And then we'll kick it off to the questions. With that, I'm going to introduce our panelists. From AngelList, we have Mike Doherty, General Manager of Venture. And from Republic, we have Caroline Hoffman, Chief Operating Officer. With that, I'm going to kick it over to Mike to tell us all about how to invest and what exactly is angel investing. Mike?
Thanks, Bianca. As Bianca mentioned, I'm General Manager of Venture at AngelList. I've been here about 6 years, and I've also become a personal angel investor as well. So the first question a lot of people have is, just what is angel investing? So angel investing is really when you're making a direct investment with your personal money into a high growth company. Generally, these are called startups, and most typically they're in the technology industry. Why is it called angel investing? This is because back when this was starting to become a trend in the early 70s and 80s, it was very difficult for a brand new company, especially one in high tech, where their future is uncertain, it's highly risky, to be able to raise financing for their company. If you go to a bank, banks are looking for years of cash flow records and revenue, and if you're a startup that's building a brand new processor, you don't actually have any business yet because you're still developing the product that you want to sell in the future. And same thing if they would go to traditional investment firms, they're looking to invest based on PE ratios and everything, and this is just something that as a young company, startups don't have. So the individuals who took the risk and put their own money into these companies became called angels. These days, angel investing is much more common, and you can really think about angel investing in venture as an asset class, similar to stocks and bonds. Stocks and bonds, for most people, should take up 80% or so of their investable assets. These are more traditional, more predictable, less risky assets. Angel investing, on the other hand, is highly liquid, it's extremely risky, and so we typically recommend that you put no more than 2 to 5% of your assets into venture capital. So we can go on to the next slide. So why do people do angel investing? There's parts of it that are very interesting, parts that make it difficult. It can be very interesting from a monetary perspective. As you'll see later, the right angel investment can actually pay off very, very well, but also most investments do go to zero. But there's also a personal aspect to it. As an angel investor, you're directly meeting and building a relationship with the founders and the people you believe in, and you're putting money behind them. So you are really on the ground floor of participating in advancing new technologies, helping companies get off the ground that may change the world, and it's a very, very different feeling than investing in a public market where you read a once-a-year update from a company and you put some money in, nobody ever knows who you are, and you don't build a relationship. So angel a lot of people actually enjoy that aspect of angel investing quite a lot. Many of the original angel investors were technology founders themselves, or people who had been in the technology industry. And so for them, it was also just a way of giving back and helping that next generation. On the other hand, it's also extremely difficult to do well. So investments, you have to be aware that investments are held for a very long time. If you put money into a company and it doesn't exit for 10 years, there's no way to trade day to day and get your money out. Your investment is there for the long term. Startups are difficult to evaluate, and this is why actually banks and traditional investment firms weren't lending to early stage high technology startups, because there is no business history. So you need to be able to build up your judgment and your skills. Another aspect of it, which is again very different than traditional investing in the public markets, is that the opportunities themselves are hard to find. Because this market is private, and companies are raising very small amounts of money, and they raise a little bit and then they don't accept more investment for a while. A very big aspect of angel investing is actually being able to discover the great opportunities before anybody else. Because if that company, say, gets money from Sequoia, fills up the round, and they never come find you, doesn't matter how good your judgment is, if you don't have the opportunity to even invest in that company, you never hear about it. So building up this skill and this capability actually takes a long time. This is where platforms like AngelList and Republic come in. So AngelList, for a bit of background, was started in 2010. We're a platform for founders. Our mission is basically to make the world more welcoming for startup founders, and we do that because by realizing that founders need to meet three types of people as they're building their company, and so we build communities around those types of people. Number one, when you have an idea, when you build something, you've just made something yourself, you need to find users, and you need to find your early adopters. Potentially, you need to find a co-founder, and that's where Product Hunt comes in. So on Product Hunt, lots of startups are launching. Other early adopters can comment and discover the product. If your product is taking off, you need to hire a team to help you scale it. And so on Talent, there are millions of people building careers in technology who are potentially looking for jobs or interested, and you can start to build your team by hiring through AngelList. And the third type of person that founders need to meet is they need to meet investors, so that they have money in the bank to build their product, to market to customers, and to hire their team. And so AngelList has built a platform for the next generation of VCs, angels who are scaling up their angel investing, becoming venture capitalists, et cetera. And so we're building out that community of people and supporting a wider variety of VCs and enabling basically anyone to become a VC. We've also spun out a few companies that all share kind of the same high level goal of helping founders and encouraging startups. One of these is Republic, so I'll turn it over to Carolyn to give a little bit of an intro to Republic.
Thank you, Mike. Thank you for that introduction. So let me give you a little bit of an introduction to Republic. And by the way, before I forget, ask your questions. Mike and I will go through them at the end. We want to make sure there's ample time to answer all of your questions about angel investing. So Republic was founded 2.5 years ago. We spun out of AngelList, and we're building a startup investing platform really on the basis of regulation crowdfunding. The real difference to AngelList is that we allow anyone, all investors, regardless of their income, net worth, to invest in startups. So you don't have to be an accredited investors. And it is free for investors to invest, so there are no other hidden fees or anything, and minimums are as low as $10. So when you think about it and you're new to angel investing, it really allows you to dip your toes into it in a somehow de-risked way. We have highly vetted deal flow, both for traditional startups as well as blockchain startups. And the deal flow is, I think, a little bit different from what we typically see in Silicon Valley. So as an example, we've had 45% female founders to date, and we also have a high percentage of underserved minority founders. So it is a slightly different picture from what you would expect from a traditional Silicon Valley startup. What I want to do next is talk a little bit about what do you need to be a great angel investor. If you take a step back, it basically requires three things. One is deal flow and access. The second one is time commitment and capital. And the third, which we'll dive a lot deeper into, is judgment and basically the ability to pick and assess startups. If I go back to deal flow and access, Naval Ravikant, the founder of AngelList, said you basically need to look at 100 deals to make one investment. I think if you use a platform like AngelList or Republic, you already have highly curated deal flow there, and you have access to it without having to be super well networked in the venture ecosystem. And that really helps basically democratize access and also not have the work of actually having to curate your own deal flow. To become a more seasoned and well-versed angel investor, you also have to make a substantial amount of investment. It is learning by doing, and I think very few people pick a unicorn, a company that becomes $1 billion startup in their first investment. So AngelList and Republic really help with that deal flow and access problem. The second one is time commitment and capital. So traditionally, you needed roughly $25,000 to make any angel investing. So if you think about making 10 to 20 a year, you realize that actually that doesn't require you to only be wealthy, but actually really, really wealthy to become an at-scale angel investor. This is another one where platforms like AngelList and Republic, and there are many others, have really helped make this more accessible by having lower minimums. In our case, it's sometimes $10 for a specific deal, or AngelList, where you will find opportunities ranging from $1,000 to $10,000 to make an investment, which significantly decreases the amount you need to actually make 10 or 20 investments a year. And then third is judgment. We like to summarize what it takes to actually assess a startup by the 4 T's. 1, the team. 2, the traction of the company. 3rd, the tech, the underlying IP of the company. And then 4th, the terms of the investment, which obviously is important because there can be great companies but really bad deals out there. So one example to just bring to life what angel investment can look like in a great upside example is Facebook. And by the way, Facebook never raised on Republic or AngelList. Unfortunately, we weren't around back then. Otherwise, we would have really tried hard to get them. But Facebook raised $500,000 back in 2004 when Mark Zuckerberg was still at Harvard in a dorm. And he raised $500,000 at a $5 million valuation. 8 years later, he IPO'd at a 83 billion valuation, and he raised 16 billion in that IPO. What that means actually is, and this is obviously an exceptional example, but there are a couple of things we can learn from that. One is, if you had invested early, the payoff you would have gotten from that is huge. You would have gotten 3,500x return, which means if you had invested $100, you would have made $350,000 through that deal. The second one is it is really long term, right? If you had invested in that seed round, you would have not seen any money until the IPO, which was 8 years later. IPO cycles are lengthening, so there is a true lack of liquidity in angel investments for that time period, and you need to be okay with that. And that's why we would never advise anyone to actually put a significant amount of their savings into it. And then there's obviously absolutely no guarantee that there is a huge payoff of any of the investments you make, right? You may be lucky, or you may be really good at assessing startups, but the outcomes of a Facebook are truly exceptional, and you will see many companies that will go back to zero. A payout like Facebook, though, will allow you to actually pay for many, many investments that go to zero, and still return an overall profit on your angel investing portfolio. So let me move to the 4 T's now. We're going to talk about team, traction, technology, and terms, and I will talk about the first 2 and then hand it over back to Mike, because you'll have heard a lot from me by then. So the first one is team. And we do this all the time when we look at companies that apply at Republic. We do use those 4 T's to actually go through our assessment on whether these are investable opportunities to have on the platform. And I'll talk about examples of companies that have raised on Republic. The first one is team. When you look at team, you're really looking at 3 things. You're looking at expertise, you're looking for passion, and you're looking for vision. Expertise and execution is probably the one that is fairly easy to assess. You're really looking for someone who understands the market that they're going into, have the necessary skills, and ideally have some track record of truly delivering on things that they have worked on before. The second thing you would be looking for is passion. Passion is so important in a startup for many, many reasons. The first one is it requires a lot of resilience, and you need someone who's truly passionate about the problem that they're solving for them to pursue this this journey of being a founder. The second is you also need to be able to rally people around you on this mission. You will have to recruit people, you'll have to excite people, and you'll have to sell your company to customers, to investors. So you're looking for someone who is truly, truly passionate about the problem that they're solving. And the third is you're looking for vision. You're looking for someone who, when they have a really small MVP type of product, can think about how this could become a company that is worth hundreds of millions or billions of dollars. So you need someone who is not only someone who looks ahead 3 months or 6 months, but really someone who looks 5 years ahead and can paint you the picture of a truly valuable company. I'd like to bring a little example to you. Arena is a company that raised on Republic earlier this year, and they have a really interesting team because they do combine lots of different areas of expertise in their company. They had people who knew product, design, some technical people, and marketing expertise. And that team really represented all the different skills that they needed to build this company. The question of passion was actually fairly easily answered because they had built this company as a passion project at night and on weekends for years before they decided to make this a full-time thing. So they had shown the resilience and had mustered up the energy of doing this in their free time for not just a week or 2, but years before they spun it out and basically decided to do this full time. And while the company Arena, as you may look at it today, is still for a fairly limited audience of largely creatives, designers, etc., they have a very clear vision of how they're rolling this out to the gig economy and freelancers and more broadly. And this vision is truly something that will bring them to the next level and help them grow much faster. So now let's move to traction. I'm going to talk about traction for consumer companies and traction for enterprise companies. I'm not going to dive deeper into research-oriented tech, such as biotech, for example, because it just requires a much deeper skill set and probably a discussion of its own to talk about traction in that area. But the way you look at traction is actually quite different, whether you look at a direct-to-consumer play or a B2B play. So in consumer companies, you look for a couple of metrics that give you a proxy of could this actually work and become really, really big? You look for highly passionate and engaged users. That is usually translated in a high number and a very fast growing number of monthly active users. You're looking at the retention rate of these users. So you don't want to have people who just hit your website or hit your e-commerce platform once and then don't return. And you're also looking at the viability or predictors of viability of the business model by looking at customer acquisition cost. Typically, you don't really look at revenue in the early stages of a consumer company. You look much more at all of these indications that they're really passionate customers who will at some point be paying for those services. But you look for growth and stickiness. For enterprise tech, it is a little bit different. And I think experienced enterprise investors, VCs, would tell you that there's basically a formula of what you're looking for. The financials are much more important. You're looking at annual recurring revenue, at monthly recurring revenue, and you're looking at growth of that revenue. You're looking at what type of name brand users they have, and you're really trying to understand their sales funnel, what's in their pipeline, what's the average contract value, how much of that is moving and how is it moving, because all of these things then basically translate into annual recurring revenue, monthly recurring revenue, and growth of those metrics. So it's a much more metrics-driven business, even in the very early stages. So I'm going to give you one example of a company that is a direct-to-consumer company that raised on Republic. It's called Everytable. Everytable was also on Shark Tank and has grown actually quite quickly. They launched 5 locations in 1 year. They had quarter-over-quarter revenue growth of 50% on average since launch in 2017. And they have actually really good stickiness, retaining customers on a month-on-month basis on 30% on average, which is actually quite good. And then they had also raised capital. They had raised over 10 million prior to their regulation crowdfunding campaign, which is a proxy to, it's basically another element of validation of someone else believes in this. So they had been able to raise actually from name VCs. So with that, let me actually hand it over to Mike for tech and product, and then also terms.
Excellent. Thanks, Carolyn. So with tech and product, what we're really looking for is at the early stage, because sometimes there's not as much traction, sometimes there's more traction, but in general, you need to try to understand whether this company is building something that a large amount of the world, large amount of the total addressable market will eventually use. So so when you're thinking about the technology or the product experience, think through, what is the problem that they're trying to solve? Is it worth solving? Is it something that people want to solve, will spend money on, or will spend their time on? Is their solution innovative? And you can also talk, because it's also very often very early, like work through with the founders on their product roadmap, et cetera. One of the guidelines I use is I try to think about products and think about, is this product 10x better than what exists today? And the reasoning there is that it's actually very hard for people to switch out of their day-to-day routine. If you think about Netflix, like they were trying to compete with television. Sure, there wasn't a direct competitor necessarily to Netflix with online video streaming, but there is a competitor for people's time, and people were using other forms of entertainment. But the experience of being able to pick and choose when you want to watch, what you want to watch, and watch it immediately is actually 10x better. And so now we see many, many people willing to pay for Netflix. In here, if you're looking at a company building a product that you personally don't use or you don't have a sense for, traction can be a proxy for user experience as well. In that, let's say it's a product that maybe I don't use, but I see that every month they're growing 50% and users are coming on, they're never churning, they're checking their phones every single day. That's another sign I can use to inform myself whether or not the world, I guess, disagrees with me and actually believes this is a great product experience. And the third part you should think about when you think about product experience is competition. You can't actually understand if something's 10x better than the competition if you don't have a good sense of what the competition is. So you can survey the market. You can the founders also should understand the market very, very deeply. And in higher tech, in like more deep tech companies, you often see more things like patents, or for consumer brands, you might see trademarks, and these can be very important to fend off competition in the future. Ultimately, though, what you're looking for in a company is something that a secret sauce about their product, just a unique insight. So to bring these into more clarity, let's go to an example. So the example I'd like to use is a company called uBiome. uBiome raised on AngelList first in June 2014. They've continued growing up from then, and last month they actually announced an $83 million Series C fundraising round. So they're continuing to grow. At the early stage, though, they didn't have nearly as much traction, so we had to try and understand their product and their team. And the product, though, is super interesting. They were the first big data company focused on the microbiome. So this is it's basically the bacteria in your skin, your gut, and your mouth. And this research into the microbiome has been a very big trend over time. There's a lot more evidence to show that your microbiome actually can impact everything from your mood to many other conditions. So looking at this, though, the experience of actually testing your microbiome and understanding what's in there, being able to do it at home is 10x better than having to get a doctor's prescription, make an appointment, go to a lab, and wait months, and like it's just overall a very unpleasant experience. So very few people had the opportunity to understand their own microbiome. uBiome was able to make that into a consumer product that many people can sign up for, or they can. It's very lightweight, inexpensive, and their doctor may prescribe it, but you can do it at home. So this is a product experience that's much better. And ultimately, as they gather more data, as they become the largest database of microbiome genetic information, there's a lot of insights they can pull out of that nobody else can. Even if somebody copies their exact product, now they have a defensible, because the product roadmap like brought them to this place where they have a huge database and can do research on top of it. They now have a defensible moat in their product. Again, just harking back to team, this team was also a very expert team that we could tell they knew the market. They had the capability to build this deeply technical product, and so it was pretty confident investment opportunity for us. The last T that I would like to talk about are terms. So we've talked a little bit about how the highest impact parts of investing in angel investing are getting access to great companies, judging whether the company is great or not. But then the actual legal terms on which you invest can be very important as well. And so you should have an understanding of what they are as well. What you'll see when you're making angel investments is there are three types of common terms. Basically, companies can raise as equity, they can raise on a SAFE, or they can raise on a convertible note. And so equity is where you actually end up with a share, or hopefully multiple shares of a company, and they've issued additional shares, so you actually get a share certificate, etc. You'll typically hear these referred to when you hear the word series, like Series A, Series B. That means it's a new class of share. Equity is ultimately what people own, and when a company IPOs, when it's in the public market, like that, it's the same thing. You're buying shares in a company. At the earliest stages, though, sometimes it can be complicated to set up equity structures very early in the company's life cycle. So some companies put that off, and that's where the SAFE comes in. A SAFE is is short for a simple agreement for future equity. This is a document where you would you'd invest in a company, you get this document, and then when they next issue shares, when they actually come to their Series A or their Series B, whatever is next for them, then your document converts into that class of equity. So eventually you do try to own equity as well. The safes are simpler in many ways for founders because they're a little bit less overhead to spin up immediately. It also lets you make an agreement with one angel after another as you're, so if you're issuing equity, you need to know how much equity you're going to issue in the entire round upfront, have more of an estimate, and like close everyone at the same time. With a simple agreement for future equity, you can actually close them on one time. What we see on AngelList is about 40% of seed stage companies use safes, about 40% use equity. Republic has a slightly modified version of a safe called a crowd safe. The crowd safe is basically just making the safe work with regulation CF, which is how Republic is able to work with non-accredited investors, so it can pool everybody together, et cetera. But conceptually, it's very similar. The convertible note is a slightly older document than a safe, newer than equity, but a convertible note was, the way I think about it really is kind of the first attempt at something that eventually became the safe. So a note also converts to equity. The goal of making this investment in the company is to hope that the company is scaling up and growing fast enough that your investment eventually does convert to align the cap table for a high growth company. But the structure they use is actually to make it debt. So you're making a loan to the company that then they can convert into, on predefined conditions, into equity. Because the goal of convertible notes are primarily around converting to equity, generally you see just a very, very low interest rate. They do need to have an interest rate because they are a loan and they have a maturity date, but generally these don't come into play. And so investors in high growth companies are hoping for 2x per year, 3x per year type of growth. And so the 1 to 3% that you might see in terms of an interest rate on a convertible note is not actually how they're trying to make their money. Other common terms that relate to these are the valuation. So when you are issued equity, you'll often hear about a company raising at a $100 million valuation, for example. And all this means is that the $100 million valuation is that if you are investing, say, $1 million into the company, you're now owning 1% of the company. It's similar to a market cap in the public markets, but we just call it valuation. It's basically if you add up the value of all the shares in the company, what is it worth? There are some details there. There's pre-money and post-money. It's pre-money means what would be the valuation of all the shares before the new investment. So if you're putting $10 million into a $100 million valuation company, if the $100 million valuation is pre-money, then post-money, the valuation will be 110 because they were worth 100 and now they have an extra $10 million, so they're worth 100 plus 10, 110. So that's the difference between pre and post-money. A valuation cap is applicable to the safe and to the convertible note, and this is the maximum valuation at which the note converts or the safe converts. Safes and notes have one downside for investors and even for founders is that because they convert later, you don't know exactly how much of the company how much of the company you will end up owning until it actually turns into that next series of shares. So if you invest in a safe at, say, what you might hear is a $10 million cap safe. If you're investing at $10 million and the company ends up issuing their Series A at an $8 million valuation, your investment will convert into that new round as if it were at the same price as the new round. However, if the company does very, very well and it converts at their first formal round is at the $100 million valuation, you also don't want to have it turn out that your investment is worth an extremely small percentage of the company because you put money in far before that next round happened and you took on more risk. So that's where the cap comes in. It'll convert at a maximum of a $10 million valuation. Discounts come into play in that situation when it's converting and the value at which it's converting is less than the valuation cap. So you may hear the $10 million cap with a 20% discount. This means you take the minimum of either $10 million or 20% less than the valuation at which the new equity is being issued. And that 20% is there to still reward you, even in the case where the company doesn't scale up to some very high valuation. But if the company is raising their next round at about the same or a little bit less, you still actually get more of that round than the new investors because again, because you're taking on risk. Generally, there's not a lot of negotiation over discounts. You'll see typically they're typically around 20%, but this is because from an investor's perspective, if you're investing in a wide enough portfolio of startups to have enough diversification, you end up you end up seeing that most of your returns come from the companies that do give you 10x or 50x returns, and so your goal is to invest in those super high growth companies, and then your return is either like 10x or 0. So if company, ideally companies are scaling up, and that's typically where they'll actually have the traction to be able to raise the next round of funding. So if a company is converting at a price lower than the cap and the discount actually comes into play, it's not a great sign. It's obviously not 0 yet because the company is still alive, but the ideal for all investors is that the conversion happens higher than the cap. And then the dilution pro rata rights are another thing to be aware of. To go back to the Facebook example, Carolyn mentioned that the valuation increased about 15,000 times from their initial round to their IPO. But she also mentioned that investors in the initial round that held through the IPO were only getting a 3,500x return. And the reason those two numbers are different is because every time a company issues more shares or raises more money, they actually end up selling additional portion of the company. And so your percentage ownership of the company, even though the value is increasing, the percentage ownership of the company decreases. Pro rata rights are something that you'll see in some investments where you get the right in the next round to continue investing and maintaining your ownership of the company. You have to invest at the new valuation, but it just is a legal right that the new investors can't kick you out, and the company has to offer additional shares to you if you'd like to take them. These can be hard to exercise for angels because the companies that do the best in their portfolio actually end up taking the pro rata rights, end up being very, very large, and angels often don't have the capital to continue investing in them. Back to that Facebook example, if you had put $100 in and then sometime in the middle you had pro rata rights and you were able to invest at 1,000x the valuation you originally invested in, now that same angel that was able to put in $100 may or may not actually be able to put in $100,000 and maintain their position. But these are super valuable. If you can get them, it's actually great to be able to have the opportunity to continue investing in the companies in your portfolio that are taking off the most. So this is something that you'll see a lot of larger investors, VCs in particular, will really be looking for because they do have funds and they are able to invest a lot, and they've saved money in what they call reserves to be able to continue investing. And so with that concludes the main content for our presentation. So the next steps, our platforms, Republic and AngelList, actually offer something for everyone if you want to get started. So on Republic, everyone can become an investor. The minimum investment is $10, and the deal flow comes from deals curated by the Republic team. So they're out looking for great startups and reviewing each of them to make sure they look like good investment opportunities before they're available on Republic. Their typical stage is seed stage to Series A, so pretty early companies. The website is republic.co, and it's super easy to just navigate there and sign up. AngelList, on AngelList, you have to be an accredited investor. We've mentioned this term a few times. It basically means you have to have $1 million net worth or an income of 200K per year. There are a couple other terms, but those are the main two conditions. And if you meet one of those two, you're probably accredited. You can go to the website to see the actual details. The investment minimum depends on the deal. So AngelList is a platform on which there are emerging VCs, there's angels, they're investing themselves into companies. And so the set of opportunities available on AngelList that any one of them might invite you into will vary quite a bit. So sometimes the minimum will be as low as 1K, sometimes it'll be up to 10K. It depends a lot on like what is this specific investment opportunity and who is leading it. And this gets into where the deal flow is coming from as well. The deal flow on AngelList is sourced by these hundreds of professional investors, and each one of them has their own unique deal flow. You may see one investor who's very good at biotech, one investor who's very good at ad tech, one investor who's very good at blockchain, this sort of thing. So when you sign up for AngelList, you actually end up applying to invest alongside each of them, and then they build their own communities and can invite you into their deal flow. So this goes to the typical deal. We also started primarily with seed stage and Series A. That's where most angel investing happens. But because we're 6 years old, there's 2,800 companies in the portfolio and many angels with different sorts of deal flow and theses. You'll actually see, we're seeing a lot more Series B, C, D, pre-IPO type of companies as well. So you can actually get a very broad exposure to the venture ecosystem on AngelList. And our website is angel.co. So you can go there, sign up for an account, and apply to become an investor, and then we'll get back to you within a day or two. Excellent. Oh, so a few more practical tips as you get started. Number one, this is by far the most important. Set aside an annual budget. Think about what's the most you feel comfortable risking in angel investing per year. And then divide that budget by a number of investments. I would probably say the minimum would be 5 to 10, but maybe even target 20 investments if you're trying to build enough diversification. We've mentioned this quite a few times, but most startups don't succeed. So, and it does take a while to, as you're investing, like understand the asset class and how to judge between startups. So, take your annual investment budget, divide it, and now you've got an estimate for how much you should be investing per company. But one thing we've seen people make mistakes is come in and invest too quickly because they get overexcited about a lot of companies. And so that leads to the second tip, which is sign up for multiple platforms, try to build as much deal flow as you can. Spend a little bit of time just looking at the sorts of opportunities before investing necessarily in the very first one you see. Think about your first 6 months to a year at least to be really learning and trying to build up your understanding of the 4 T's and judgment and et cetera. Another way you can continue to learn on Republic is you can actually, there's Q&A with each of the founders who are raising money, so you can actually interact with the companies. On AngelList, it's primarily these syndicate leads, these emerging VCs who are actually running the deals. So, and they're communicating with the founder offline. They're making direct investments. But it's actually really nice because you can interact with them, and these are expert professional investors. And so I've learned a lot. A lot of our users, this is one of the main things they like about AngelList is that they can actually get an insight into how our expert investors doing this. And finally, the way that most people get their initial and largest exposure to the technology industry is actually working at a startup. So if you are not yet working at a startup and you're interested, AngelList has, in the last year, we've had about 50,000 people find jobs at startups through our jobs platform. Again, angel.co, sign up, show that you're looking for a job at a startup, and there are thousands of startups there looking for people as well. Finally, the next page will include a long list of resources, blogs, articles, etc., that you can read. These people are all experts in the industry as well, and you can learn quite a lot by reading avc.com, by listening to the A16Z podcast, etc. With that said, thank you so much for attending. We're going to open up to Q&A now. And I think Bianca will be organizing that.
And I have had the time, because I wasn't speaking, Mike, I have had the time to look at a couple of questions. So first off, I wanted to say, if you go onto Republic's blog, there are a couple of blog posts actually written about the 4 T's, which we just spoke about, resources, which Mike just shared on the last slide, and like resources to learn more about tech, as well as I think you can find a recording of one of the last webinars as well. So there are plenty of resources on Republic's blog to dive deeper and basically get summaries of what we just talked about. I'm going to just talk about a couple of questions that I saw that were a little bit more specific to Republic. And then we can also go to more general questions about angel investing. So there was one about how do we avoid adverse selection of deals coming to Republic. We have a diligence process where we reject 90+% of companies that apply to Republic. And we truly look for investable opportunities. It is 100% guaranteed that we won't get it right all the time, but we truly do curation. And one of the biggest filters we have is we do actually look for proxies of traction, and we do look for runways of these runway of these companies, right? So when we ask a company, how are you thinking about fundraising, and how much money do you have in the bank? Do you have enough money in the bank to run this campaign and promote this campaign? That's one of the most important filters. I think there's also this belief that any company that couldn't get funded in Silicon Valley is not investable or investment worthy. I think we're really trying to dispel that myth. There are many reasons you wouldn't be able to get funded in Silicon Valley, and that may just be because your network doesn't extend that far, and because you don't happen to have founded your company in Silicon Valley or on the East Coast, and it's harder to network your way into that. And so we really try to look for investable opportunities that have traction, that have runway, that may or may not be a unicorn, but you know, even a 10x is sometimes good, and it doesn't have to be 3,500x like the case of Facebook. And we truly try to look for these opportunities. Another question I saw here is the question of like someone saying we were doing SAFTs, simple agreement for future tokens. For the blockchain companies, we actually don't use the SAFT, and we never have. We use a token DPA, which there's some research on our website about that as well, but we believe it has actually better investor protection than the SAFT. And Republic has never used the SAFT, the simple agreement for future tokens. There was some questions about how we vet companies in the blockchain space. I don't want to go into this too deeply because one, I'm not our resident blockchain expert at Republic, so me doing a long speech on that would be slightly misguided. We have some resources about how we select, but I can only say we're probably even more selective on blockchain companies. We do try to really vet the founding team, and we have some real experts on the team who do just vetting blockchain startups all day. So we try to pay close attention to that.
So I can answer a couple of questions. I saw there were a few AngelList specific questions as well. Number one, anonymous attendee asked, what exactly are the syndicates in AngelList? So a syndicate is basically a set of followers for a specific investor. So you might have someone like Zach Coilius or Jenny Rook. You may find their syndicate on AngelList. What happens to you as an investor is you would take a look at Zach's background or Jenny's background, and you might then apply to join their syndicate. This doesn't necessarily mean you are going to be investing in their next deal. It also, the other side doesn't commit you to investing in their next deal. From what they do is then they take a look at who you are, your application, and they can accept you into the syndicate. And then when they are making their next investment, then they can choose to invite you in. Generally 95+% of people who have been approved to invest on AngelList and apply to a syndicate are accepted, and then they start getting invited to deal flow. So the way to best use AngelList is actually to start, we have some tools, in fact, to help you browse syndicate leads, but start looking for leads that are investing in the types of companies that you're interested in, apply to their syndicates, and then you'll start seeing their deal flow. And each time they invite you to a deal, they'll write up a large investment memo of why they're investing. You'll get all the details about the company, et cetera. We typically suggest when someone signs up for an AngelList to apply to about 15 to 25 syndicates in order to build up enough deal flow that you're going to be able to invest more in a diverse set of companies. The other thing you'll find sometimes as you're backing syndicates is a lot of these people, these syndicate leads, eventually, as they grow in their career, they become VC leads, and so they may start a fund. And so you may also find yourself getting invited to funds. One nice thing about syndicates is that by investing deal by deal alongside of someone, you get to see how they think, what kinds of companies they're investing in, et cetera. And so by the time you may get invited to invest in their next fund, now you actually know this person, you've invested with them a bit, and so so it's can be a little bit easier to decide whether or not to invest in someone's fund. And actually, both the two examples I mentioned, both Jenny and Zach have raised funds at some point, and so they do funds. They still sometimes do deal by deal syndicates, but their network of people that are interested in investing alongside of them continues to grow through AngelList. So thank you for the question. Another question that came up is the AngelList Analyst Program. And so I will just selfishly, I'll mention a few of the positions that we're hiring for. The Analyst Program is a year or two long program at AngelList. We're typically looking for people that have had 1 or 2 years work history, or sometimes coming right out of school, who want to get into venture and work at AngelList. Each analyst during the program, it's a great way to really build a lot of understanding, because you end up working on 30 to 45 investments per month. Some parts of it are operational, and you're working on just like making sure the docs are in place and money is moving and people are happy. But a lot of it is also relationship building with some of these top investors, like working alongside of them as they're making their investments. And then throughout the program, actually, analysts also take on projects at AngelList. So they've done everything from kick off new types of funds to working to going and working more as a product manager and some product features and stuff as well. So it's a pretty good way to get a venture career started. And I highly recommend it to anyone who's at an early point in their career and wants to explore venture.
I can take another question. There were a couple about international investors and international companies raising. So first off, yes, as an international investor, accredited or non-accredited, you can invest on Republic. There are very few exceptions, North Korea and Iran being two. So all it takes is basically a credit card, and we have low minimums. There were also questions about being able as a non-accredited investor to invest in like companies like Coinbase, AngelList, Product Hunt, Gemini, Airbnb, Lightning, Blockstream, HackerNoon, etc., that are pre-IPO. Basically, you cannot necessarily, most of these companies at this stage are too big to even let angels in. They would have to be listed on one of those on one of the investment platforms. AngelList is reserved to accredited investors. Republic has everyone. So in general, as a non-accredited investor, you cannot invest in these companies, and there are typically no public offerings to invest in these companies happening. And then there was another question around, if I'm a foreign startup, can I raise on Republic or AngelList? And if I'm a foreign startup, how do I actually get introductions to investors in the Valley or in the US without being on site? So as a foreign startup, you need to be a US incorporated entity in order to raise on Republic. We have had cases of companies that have opened a US subsidiary in order to do a Republic campaign, and that is totally possible. But excuse me, but you need to have a US company. Excuse me. And then finally, I think it's very hard to fundraise if you're not on site. So sorry, I just have a bit of a bout of cough. If you're not on site, it's quite difficult. So network your way into it and probably plan on spending some time in the US to do the fundraising.
So I can answer another question. Another person, again, this is a lot of people are interested in investing in other regions. And so there's a question about, do you need to invest or be based in Silicon Valley to generate exceptional returns? What do we think about startup hubs like New York, London, et cetera, from a risk return perspective? I can speak from what the trends that I've seen in the market are, which is that it is actually becoming much more of a trend to invest outside of Silicon Valley. Some of the arguments against starting a company in Silicon Valley are that it's extremely expensive to live there. And so, you know, $1 million fundraise maybe can only go to a couple of engineers paying rent, basically, in Silicon Valley, and maybe you can do more in other areas. So there's been a big trend in the last few years to start looking outside. New York is definitely our second biggest hub. Republic is based in New York. We've also seen a lot of growth in Canada. The Canadian ecosystem is super interesting. Lots of high-tech expertise coming out of Waterloo in the Toronto region, et cetera. And what we've seen actually is a lot of US angels are now flying back and forth to Canada pretty frequently to invest there. In the Midwest, there are firms like, sorry, I just lost the name. Oh, New Stack Ventures. New Stack Ventures is based in Chicago, and there are a number of other firms kind of growing up on AngelList. We have a couple of funds being raised right now that are planning to invest in the Midwest. We've seen high growth companies come out of Florida. Magic Leap, Chewy was recently acquired for over $1 billion out of Florida. And then our international offices beyond Canada, we also do have an office in the UK. We have one in Germany, and we recently launched in India this year. And so we fundamentally do believe that innovation, the ability to start a company, should be distributed across the population, no matter where you are. And the internet and technology now can connect people around the world. So a company started in India could have customers in the US, they could have customers in South America, et cetera. So it's a pretty exciting time. As companies scale, you do find that that you want to be in a tech hub, at least have some sort of presence there, because follow-on investors are very important. So having a concentration of investors in Silicon Valley has been a big advantage as these companies scale up to the point where they need $100 million or $500 million to continue growing. They can find those investors more easily in Silicon Valley. The other one is hiring engineers and hiring your team. If a company is at the stage where they need to hire 500 or 1,000 people with startup experience in 1 year, there are very, very few places in the world currently where you can do that. But we have, as I mentioned, we've seen a large trend of more startup ecosystems really getting off the ground around the world. So I'm pretty excited about it myself, and I think you will see a trend there. I can't personally speak to exactly what the risk return perspective is, because we can't get into like guessing about returns, about specific opportunities. But I know that there are opportunities around the world. So thanks again for that question.
I know we're running up on time, so we're gonna end with 1 minute over 1 p.m. Thank you very much for joining today. Really appreciated having so many people. And if you have any more questions, please email us. And we'll also try to follow up one-on-one. There are a couple of specific things. We'll follow up on those one-on-one after this webinar. Thank you very much.
Thank you.